What if I told you that a single executive decision, choosing the wrong export market, could wipe out 30% of your international revenue overnight? That's not a hypothetical. In 2018, when the US-China trade war escalated, thousands of companies saw their profits vanish in weeks due to sudden tariff impositions. But here's what's even more shocking. While many businesses were scrambling to mitigate losses, others thrived because they had already diversified into non-tariff markets. According to the International Trade Center, companies that actively pursued non-tariff destinations saw export growth rates up to 3.5 times higher than their tariff-exposed counterparts. So why are so many businesses still betting the farm on a handful of high-risk, tariff-prone markets? Is it complacency or just a lack of strategic foresight? Today's global trade landscape is no longer a game of low-cost production and high-volume exports. It's a chessboard of shifting alliances, regional trade agreements, and politically volatile tariffs. The real winners? They're the businesses that proactively expand into stable, non-tariff markets, and in doing so, create resilient international revenue streams insulated from political upheaval. In this episode, we'll explore how forward-thinking companies are navigating this new terrain. We'll unpack the explosive growth of non-tariff market sectors, uncover why these markets matter more than ever, and show you how to seize opportunities others don't even see coming. So if you're ready to future-proof your business and unlock sustainable growth, this is where your strategy begins. Over the past decade, non-tariff markets, countries with lower trade barriers, stable political climates, and favorable regulatory environments have quietly become the backbone of international commerce. While the media spotlight often shines on titanic trade conflicts, what's gone under the radar is a quiet revolution. Emerging markets in Southeast Asia, Africa, and parts of Eastern Europe have become increasingly attractive to exporters due to their bilateral agreements, growing middle classes, and improved infrastructure. Take Vietnam, for example. Once overshadowed by its giant neighbor China, Vietnam has surged as a manufacturing and export hub, thanks to its participation in trade agreements like the CPTPP and EVFTA. Samsung, which once relied heavily on Chinese production, now manufactures over 50% of its smartphones in Vietnam. The result? Greater cost control, tariff insulation, and diversified risk. This growth isn't just about government deals or tax breaks. It's also driven by technology. Advances in fintech, logistics, and supply chain transparency have made it easier than ever to do business in markets that once seemed too remote or bureaucratic. For instance, digital customs clearance and blockchain-based logistics systems have cut red tape in countries like Rwanda and Kenya, opening doors for exporters looking beyond traditional destinations. Culturally, these markets are also evolving. Young, tech-savvy populations with increasing disposable incomes are reshaping consumption habits. Local demand for global products, from fashion to fitness to fintech, is on the rise, and businesses that enter early can build brand loyalty before the market gets saturated. The message is clear. Non-tariff markets are no longer a backup plan. They are the main stage. To ignore them is to leave opportunity on the table. Expanding into non-tariff markets isn't just about identifying a promising region and jumping in. Strategic timing and precise market positioning are critical. One of the most common missteps companies make is entering too late, after competitors have already secured distribution channels, built local relationships, and established trust. By then, the cost of entry is much higher, and the odds of success significantly lower. A textbook example of excellent market timing is Unilever's expansion into East Africa. Instead of waiting for consumer demand to reach Western levels, Unilever invested in early-stage infrastructure, created locally relevant products, and partnered with micro-distributors. They weren't just selling products, they were building ecosystems. Today, Unilever is a household name in regions that many multinationals are only now trying to penetrate. Positioning also matters. What sells in Paris might flop in Manila. Businesses must adapt their branding, pricing, and even packaging to reflect local values and norms. Netflix's entry into India provides a perfect case study. After launching at Western price points and seeing lackluster growth, the company introduced mobile-only plans tailored to the Indian market. The result? A surge in subscriptions and an entrenched market position before local competitors could respond. On the execution side, resource management is pivotal. Many businesses overextend, allocating large budgets to splashy campaigns without fully understanding local distribution bottlenecks or regulatory challenges. A smarter approach involves pilot testing in select regions, building local partnerships, and scaling gradually based on real-time data and feedback loops. If there's one takeaway here, it's this: enter early, customize wisely, and scale with discipline. The companies that succeed aren't the ones with the biggest budgets. They're the ones with the... Despite the immense opportunity, non-tariff markets come with their own set of challenges, many of which are nuanced and easy to overlook. Local bureaucracy, currency fluctuations, and shifting regulatory standards can complicate operations. That's why businesses must build adaptive, resilient structures from day one. One effective strategy is to develop localization cells, small, agile teams embedded in the market who understand the local landscape and can respond faster than remote headquarters ever could. Coca-Cola has mastered this with its decentralized management style. In markets like Nigeria and Indonesia, decision-making authority is delegated to local teams who are deeply in tune with regional dynamics, allowing for faster pivots when the market shifts. Technology is another linchpin of resilience. Cloud-based ERPs, real-time demand forecasting, and AI-driven market analysis can provide the agility needed to course-correct quickly. Consider Zara's parent company, Inditext, which uses data from every store worldwide to make inventory and design decisions in real time. This responsiveness is crucial in non-tariff markets, where consumer trends can shift rapidly and without much warning. Then there's the human side. Building strong, transparent relationships with local suppliers, distributors, and even government stakeholders is non-negotiable. Corning Incorporated, a glass and materials science company, spent years developing trust-based partnerships in Latin America before scaling. Today, they benefit from deep supply chain integration and favorable regulatory treatment, a direct result of long-term investment in local goodwill. Looking ahead, the future belongs to companies that combine strategic foresight with operational resilience. It's not enough to expand, you have to embed. This means not only securing market share, but building ecosystems that support sustained growth and innovation. The global economy is no longer shaped solely by the giants of yesterday. As geopolitical tensions rise and trade barriers reconfigure, the future of international business lies in agility, diversity, and strategic foresight. Expanding into non-tariff markets isn't just a hedge against tariffs, it's a proactive play for long-term dominance. We've explored the explosive rise of these markets, unpacked real-world strategies that work, and highlighted the key considerations you need to stay competitive. Now the question is, are you ready to act while others hesitate? Because in the new world of global commerce, hesitation doesn't just cost you market share, it costs you resilience. And resilience, in this economy, is everything. What market will you explore next? Let us know in the comments, and don't forget to subscribe to Shaun Academy for more insights that give you the edge where others settle for average.